I wanted to run you through this 5-year dual directional note by JP Morgan. As you can see, it's uncapped, it's contingent, and this note is based off the S&P 500, the Russell 2000, which is small caps, and the Dow right here. And what you're looking at is the lesser of that index. So whichever performs the worst, that would be the index that we're looking at. So when that index itself, the lesser of those three, is positive, so above zero, and they're usually pretty correlated, but when it's above zero, you get a return of 140% of that amount at least. So for example, if the lesser amount was up 40%, you would get a return of 56%. Up 65, you get a return of 91. Okay? Now, this is the part I think is really attractive. When the market is down, and that's what the green line is, the market. When the market is down, you actually get a positive version of that negative return. So if we're looking here, if the market's down 15%, you get a positive 15%. Down 30, you get a positive 30%. If it's down 30.01, any more than 30, you get the loss as if you had invested in that index. So the real question is, how often does this happen? How often are we here and we get this leverage return? How often are we here and do we get a positive return when we would have had a negative return? And how often are we here where we get a negative return that we would have gotten otherwise? So I did the math. And oh, by the way, this is a May note, and this has already expired. You can't invest in this anymore, so it's already closed. But there will probably be one out in June and July and the following months. So let's take a look at the math. Okay, here's the data, and this goes May 2020 and goes all the way back. I'm going to run it all the way back down to goes the 80s, actually 79. But here's a 5-year return for the S&P 500, the Dow, and the Russell. That would be 5 years. If I wanted to take a look at how this returned over 5 years, that's my return. Okay? 65%. For the Dow Jones, it would be 45%, and for the Russell was massive, all up 150% during that time. So the lesser of those three would be 45%. But remember, that's leveraged by 1.4, which is here, so that ends up giving you a 63.6% return. So right in line with the S&P 500, outperforms the Dow, and underperforms the Russell. But still, 63% over time is over 5 years is roughly over 10% compounding average annualized return. So we look at how this data did over time, and we amassed over this past 40 years and collected this information. So let's just take a look at the S&P 500. The S&P had 5-year positive returns, 354 months, but it had 83 negative 5-year months. So it was positive about 81% of the time, negative 19% of the time. When it was positive, it gave you a 76% return on average. When it was negative, 11%. The worst 5-year return, 35.8%. So the average return over that time was 59%, and it gave you just under 10% for an annualized average return. Now, run through the same numbers with the Dow. When the Dow was up, it was up about 72% over those 5-year periods. Its positive count, 380 months. So that was about 13%, I'm sorry, about 87% of the time. And 13% of the time it was negative. So 57 of those structured notes would have been negative. And the Russell, 62% positive returns. And then only 37 of those periods were negative, so 8.5%. Now this dual note, we really want to know how safe and secure it is. So out of 437 months, it was positive 436. Only negative 1 month. It happened to be that March month of 2004, where it would have matured in March of 2009 at the very bottom of the financial crisis. Okay, so 0.2% of the time, this note would have been negative, with an average return of 63.2%. which outperformed the Russell, the Dow, and the S&P on average, with no negative, with well, one negative month. Basically, no chance or very small chance of having a negative return. Now, that chance does exist, so we can get around that, and we'll talk about that a little bit later. But keeping in mind, the standard deviation or the volatility is much less because of the way these structures work. So the risk reward is much higher than what you're going to get for all of these different indexes. So you still get more upside with less risk. But what if you just happen to be very unlucky and you're the guy that buys this note during this 1 month? Well, what you want to do is you want to ladder this in. So perhaps you're going to put $100,000 to work. Just use a round number. Instead of putting $100,000 to work and maybe you get that 1 month, in which case that $100,000 would only be worth $65,000 by the end of the note because it was down 35%. You ladder it in, so you buy $10,000 over 10 months because the March 2009 note was negative, but the February and April note would have been positive. So even though you would have lost 35% on that one note, the other notes would have outperformed. Okay, so on average, even if you bought 10 notes, you'd be very unlikely to have gotten this one negative number. But let's say you did. And if we ladder them in and buy 10,000, 10,000, 10,000, on average, even though if you do lose that 1 month, on average, you're going to get, instead of 10,000, you'll get $16,000 back. So more than make up for that loss, and way better than the odds that you would get if you were with the S&P 500, the Dow, or the Russell, by far. Okay, so these numbers down here are times that this note outperforms. So over the last 40 years, this note would have outperformed the S&P 500 70% of the time, the Dow Jones 63% of the time, and the Russell 71% of the time. So again, as we extend the time frames and the number of notes that we use, very similar to the logic at Las Vegas, the more games we play with the odds in our favor, the more likely it is we're going to outperform. So if we buy 10 notes, odds are 7 of these are going to outperform these indexes. 3 might underperform. Very unlikely we'll get a negative number, but much more likely that we would have a negative number if you had bought the S&P, which is 1 out of every 5 5-year periods, which is quite a bit. Okay, so to wrap up, your expected value or your expected return is higher. Your volatility is lower. The chance of losing money is less than 1%. It's less than 1/2 of 1%. It's 2/10 of 1%. So super small, and we mitigate that risk by laddering notes in over time. So you can get cash flow as you go in your retirement accounts. And the volatility is lower. And there's a couple other tricks we can do to amp up this volatility, but this particular note seems fantastic if you are a long-term investor that wants upside of the market, doesn't want the risk associated with the S&P losing 40 or 50% of its value every 5 to 10 years like it seems to be doing. So that's not what's going to happen here, and you still get these upside returns. That's a dual directional note, and it's also less expensive to run. So my fees are even cheaper than what would have been if I'm running a full-on portfolio for you that requires maintenance all the time. Okay, so I hope that explains it and how you can use this note in order to make basically a no risk, no fail retirement portfolio. Thank you so much.